Thinking about getting a credit card? Or maybe if you should get another credit card? Well, this video is going to give you a few quick tips that you might find helpful. Things we're going to cover in this video. First, things to look out for with a credit card. Second, general credit card management tips. And third, how you can be a pro with a credit card. Things to look out for with credit cards. First, credit card debt. Whether it was caused by car repairs that were unexpected, or maybe your HVAC system went down in your house and you had to buy a new one, or a sale that went on in Target so you get these really cute booties. Whatever it was caused by, the debt on a credit card is terrible and you should avoid it at all costs. So here's why and how you can avoid it. Basically, credit card interest is compounded differently than other loans, and it's actually compounded daily instead of monthly, which makes it way more expensive. Let me explain. Let's say you had a $1,000 balance on your credit card and you're getting a 26.5% interest rate. To figure out how much you'll pay in interest, you'll take the APR divided by 365 days in a year, or 26.5% divided by 365, which is going to get you a really small decimal of 0.0726%. You might think, well, that doesn't seem so bad. Well, just you wait. Then you take your average daily balance times your days in a cycle or month times your daily interest. So in this case, you take your $1,000 times, we'll say 31 days in a month, times that tiny little decimal we just calculated at 0.000726, and that comes out to $22.51 per month. That means that every single month you're spending $22.51 on your $1,000 loan. Just for comparison's sake, if you were to take a $1,000 personal loan out at Class Act, your rate would probably be closer to something like a 9%, for example. Calculated annually, you would pay something closer to $7.50 per month to have it paid off in 1 year. So yes, credit card debt is worse than other loans. Not only that, but if you only made the minimum payment on your credit card each month, it would take you over 8 years to pay it off, and you would spend almost $1,500 in interest versus the $90 that you would have paid in 1 year on a personal loan. Crazy. On top of the endless debt cycle that credit cards can create, they can also be damaging to your credit. Now, let me stop you right there for just a second, because not all credit cards are bad. It all depends on how you use them. They can actually be one of the best things to boost your credit score too. Now, your credit score cares about just a few things. 1, whether or not you're making your payments on time. 2, what your oldest credit card is and how long that history has gone on for. And 3, what your utilization ratio is, which it checks at random every month. Without going into a ton of detail, just know that you want to make sure that you're making all your payments on time, that you've had your oldest card around forever if possible, and that your utilization ratio is below 30%. Now let's talk about that for just a minute. You have your credit card balance, right? And then you have your credit limit. You probably know what your balance is because that's what you owe every month. Your limit should be listed on your account as well. You can always call your credit union or bank to ask them what it is if you need to. So even though you may have a limit on your card of, say, $1,000, that doesn't necessarily mean that you want to spend the whole $1,000. This will hurt your credit, which is weird, right? And really, they check it at random every month, so you might squeak by with going a little bit over, but just to play it safe, let's say you keep it below your 30%, or in this example, you want to keep it below $333 at all times, or you could be hurting your credit. And we want to keep your credit looking nice and squeaky clean. So let's just watch that. Now, in reality, the credit card companies are going to group all of your revolving credit together. And revolving credit is like credit cards. There are other things like your lines of revolving credit. We'll go over that in the future. But let's say you had 5 different credit cards, and they all have their different credit limits. They're going to take all of those limits and add them together. So in this case, $10,000. So you want to keep all of those credit cards' total balances under 30% of that $10,000, or you could be hurting your credit, which matters. But I'll go over that in a future video as well. So now for some basic credit card management tips. Like I said before, you have to be at least 18 in the US to get a credit card. But if you can get a credit card at 18, I think that's ideal. Now, it may have to be a secured credit card to start out with, but with $500, a job, and a little know-how, a secured credit card might be the best way to set you up for financial success in your future. But don't go crazy opening credit cards all over the place or even applying for credit cards over the place, because banks get a little leery of that. Find a good credit card, apply for it, get the credit card, and then use it. But don't use it to pay for things that you can't afford, because that's a great way to get yourself in a ton of debt and pay lots of money in interest, which I work for a credit union. We make our money from interest. So it might be good for me, but it's not going to be great for you. So once you get your credit card, make sure that you pay it off in full before the first payment is due. That way, you're not paying any money in interest. See, credit cards don't have to be that bad. So you might ask, well, Ryan, what good is a credit card if I'm just paying for things that I can already afford anyway? I could just use a debit card. Well, let me give you 3 reasons. First of all, it's going to help you build credit. So with a credit card, you're showing that you can actually make these payments on your card, and credit companies really like that, so it helps your score go higher. Second of all, you're able to make larger purchases a lot of the time than you can on your debit card. So with a credit card, you can go into Lowe's and you might be able to buy that like $1,500 lawnmower, whereas with your debit card it might max out at like $500 at a time. The third thing is that your credit card is going to be a little bit safer, a little less risky than a debit card, because let's say you lose your credit card or lose your debit card. If somebody finds your debit card, they can swipe it and the money is going to come straight out of your checking account and you're just going to be out of that money. Whereas with a credit card, you're just using credit, so that money that they stole from your credit card when they swipe that isn't actual money coming out of your account, it's just credit that you have on the card. So you can dispute that purchase and you're not without all of that money during that period of time. Finally, how can you be a pro with your credit card? Rewards. So we've gotten you to the point where you're not spending any money on interest anymore. You're building your credit score rather than damaging your credit score with your credit card. You can also get rewards. And let me just tell you, I've used some different credit cards in my day, and they've paid for my trip to Costa Rica, my trip to Denver, and even my trip over to Europe. So they can be pretty great if you're looking out for the right credit cards. And we're going to have a video about all that and how to get the best rewards in the future. If you have any questions about credit cards, credit unions, debt, let us know in the comments. We would love to hear from you. As always, if you enjoyed this video, hit that like button. And if you want to see more videos like this, then subscribe. And even hit that little bell and it'll let you know when a new video comes out. Because we've got new videos coming out the first and third Monday of every month at 6 a.m. sharp. So keep a lookout and we'll see you next time.